Imagine walking into a bank with $100. You hand it to the teller. They type something into a computer. You walk out thinking your money is safely stored. But something strange just happened. Your $100 did not go into a vault. Instead, it quietly multiplied. Within the financial system, that same $100 can become $200, $500, even $1,000 of new money. No gold was mined, no work was done, no new wealth appeared. Yet the money supply grew. This sounds like financial wizardry, but it's not magic. It's the modern banking system. And today, we're opening the vault to reveal one of the most misunderstood mechanisms in economics: how banks actually create money. The Great Misunderstanding. Most people imagine banks as giant piggy banks. You deposit money, banks store it, later someone else borrows it. Nice and simple. Except that's not how modern banking works. In reality, banks operate under something called fractional reserve banking. That phrase sounds like something invented by accountants who wanted to make economics sound boring. But hidden inside it is a financial machine that quietly manufactures money. Let's rewind a few hundred years, because this story begins with goldsmiths. Yes, the original bankers were literally metalworkers guarding gold. The goldsmith discovery. In medieval Europe, wealthy merchants stored their gold with goldsmiths. Goldsmiths had vaults. Merchants received paper receipts proving ownership of their gold. Over time, something interesting happened. People stopped withdrawing the gold. Instead, they simply traded the receipts. The receipts became money. And the goldsmiths noticed something else. Almost no one withdrew all their gold at the same time. So the goldsmiths had an idea. If they held 1,000 gold coins, they could safely issue more receipts than they actually had gold, maybe 1,500, because statistically, not everyone would redeem them at once. And just like that, fractional banking was born. The goldsmiths had discovered something powerful. Money is not the gold. Money is the claim on the gold. Modern banking. Fast forward to today. Gold is mostly gone from the system, but the mechanism survived. Modern banks do something similar, but digitally. Let's walk through a simple example. You deposit $1,000 in a bank. The bank does not lock it away. Instead, regulations allow them to keep a fraction of it in reserve. Let's say 10%. So the bank keeps $100 in reserve and lends out $900. Now the borrower spends that $900. Maybe they buy a laptop. The seller deposits that $900 into another bank. That bank now keeps 10%, or $90, and lends $810. And the process repeats. $810 becomes $729. $729 becomes $656, and so on, like financial dominoes. That original $1,000 deposit can eventually support around $10,000 in total bank money. Welcome to the money multiplier. Wait, did the bank just create money? Yes, but not in the way most people think. Banks don't print physical currency. Instead, they create deposit money. When a bank issues a loan, it doesn't hand out existing deposits. It creates a new deposit in the borrower's account. On the bank's balance sheet, loan equals asset, deposit equals liability. New money enters circulation. This is why economists sometimes say loans create deposits, not the other way around. And this is the shocking part. Most money in the economy was created this way. Not by governments, not by printing presses, but by commercial bank lending. How much money is created this way? In most modern economies, about 90 to 95% of the money supply exists as bank deposits. Physical cash? Only a tiny fraction. The majority of money exists as numbers in bank databases, digital IOUs, which means the modern financial system runs on something deeply intangible: trust. Trust that banks remain solvent, trust that borrowers repay loans,
Trust that the system keeps flowing, because if that trust breaks, the entire system trembles. The danger: bank runs. Remember the goldsmith trick? Issuing more receipts than gold? It works beautifully until everyone wants their gold back at the same time. This is called a bank run. Depositors rush to withdraw money, but banks only keep a fraction of deposits in reserve, so they can't pay everyone simultaneously. This happened repeatedly during financial crises. The Great Depression saw thousands of banks collapse this way, which is why governments introduced deposit insurance, central banks as lenders of last resort, and banking regulations to keep the system stable, because fractional banking is powerful but fragile. The real rabbit hole. Here's where things get interesting. If banks create money when they lend, then who decides how much money exists? Answer: credit demand. When people borrow more, money supply grows. When loans are repaid, money disappears. Yes, money can literally vanish when debts are paid off, which means modern money is fundamentally tied to debt. The global economy runs on a strange engine. Debt creates money. Repayment destroys it. This is why credit booms create economic expansion, and credit crashes create recessions. The central bank role. Central banks don't directly create most money. Instead, they control the conditions for lending. They influence interest rates, bank reserves, and liquidity in the system. Lower rates, more borrowing, more money creation. Higher rates, less borrowing, slower money growth. Think of the central bank as the thermostat of the economy. It doesn't produce the heat, it adjusts the environment. The big question. Now step back and look at the system. Most money is created by banks. Banks create money when they lend, and lending creates debt obligations. So the modern economy is built on a fascinating paradox. Money is both the fuel of growth and a promise to repay something in the future, which raises a philosophical question economists still debate today. Is money a thing, or is it simply a network of promises? The next time you walk past a bank, remember, inside those quiet buildings, no printing presses are running, no gold bars are moving. Yet every day, billions of dollars of new money quietly appear, created with a keystroke, backed by loans, powered by trust. It's one of the most elegant and controversial systems humans ever built, a system where money is not dug from the earth, but written into existence. And once you see it, you realize something profound. The financial world isn't made of coins or paper, it's made of agreements. If this changed the way you see money, comment below. Money is trust. And if you want to go deeper down the rabbit hole, watch the next episode, Why Governments Can't Just Print Unlimited Money, because that story is even stranger.